Hoffman here. It's March 7th, 2025, doing the TheoTrade weekend update here with about 40 minutes left in your trading week. Well, right down to business here, of course, in this TheoTrade weekend update. S&P's right now up about 24, 25 points. I mean, for the most part, what is that? It's pretty much massively unchanged versus some of the price action that we've seen throughout the course of this week. And what else do you say? Volatility is absolutely raging. The big question, though, is did we see the bottom or are we about to see the abyss? We're actually going to break a lot of this down for you here, of course, again, on this TheoTrade weekend update. Let's get right to it. So let's start in the S&P futures, right? The likely place over here, the futures, because the futures drive order flow to the marketplace. And looking at them, of course, you know, the discussion last week was the crack of the volatility box. For those of you that have actually tuned in kind of week in and week out, been talking just incessantly, of course, about this very significant volatility box. And that volatility box, okay, was really from the 5,900 to roughly 6,100. And I mean, we've been in it for an incredibly long period of time. You had all of November, December, you know, January, February, and here we are obviously in early March, okay, with a violent move outside of it. And that's one of the things we've been warning of, you know, week in and week out. When you're in a volatility box like this, you just tend to kind of accumulate open interest in the options marketplace. And that options marketplace, the open interest just grows and grows and grows. And you get this just huge magnitude. So when we came out of it, okay, it's a burst to the downside. Now, as I was saying a moment ago, everybody's kind of looking right now and kind of thinking to themselves like, look, we hit 56.73 earlier today, right? It's getting hammered out there. Bottom? Was that the bottom? Or are you about to see the abyss? Well, for that, look, truth be told, you got to go deeper than just the S&Ps, right? You got to go deeper than just the S&P futures, which, you know, oh, they look ugly right now. They're in oversold territory. You know, the irony of that, when people say oversold territory, yeah, you're oversold maybe on the daily chart. When you start snapping to like a weekly chart, you know, you're just getting going. And, you know, the irony is, again, if you even go to a monthly chart, you know what that ding was on the monthly chart? In all seriousness, that ding that just happened over there, and I'll actually show it to you again. So I pull up this RSI Laguerre. It's just like an RSI, but when I go to the RSI Laguerre and I actually move to a monthly chart, that ding is actually the sell side ding, meaning that we're just entering in, okay, for a sell-off. So think about that for 1 second, because that's the monthly chart. And the monthly chart is, you're still in overbought territory. This is now the trigger to sell. You're looking at this and you're like, oh, that's kind of what? It's intimidating. Of course it is. So as I said, look deeper than just on the surface. Like, look, of course, in the short term, we're a little bit oversold. But the bounce today is really, really meager. You would have expected a bigger bounce. We're going to talk about bounces when we get a little bit deeper into this here today. So where do we go? Like to decide, like, did we see a bottom or the abyss? The first thing I want to talk about is sectors. Okay, and specifically some of the sectors we're going to look at. In fact, I'm going to start with this just to give you a feel. Like, you know, there's some sell side activity. Things have been getting a little crazy out there. You know, is there cause, you know, for concern? I think there still is. And again, I'm going to give you an opinion right off the bat over here. When it comes to the marketplace as a whole, what I don't like about this marketplace right now, okay, and it just doesn't exactly like give me a warm and fuzzy feeling. Now, I'm not here saying that, you know, oh, we haven't hit a short-term bottom. Probably, okay, could use a bounce in here. But overall, okay, I don't feel warm and fuzzy about the marketplace, and really do believe that there's still going to be some more downside. And I'm actually going to give you a couple of those reasons right here, right now. One of the number one reasons that I think we can see continued sell-side activity. Just look at something like the financials. I'm not saying the financials the only sector that matter, because they're clearly not. Okay, but I want you to look at the financials, and I want you to recognize that the financials hit their all-time high on Monday of this week. So have you ever seen like a big sell-off in the marketplace? Oh, it's a big sell-off in the marketplace. Yeah, where like a major sector like the financials just came off their all-time high. They were all-time high on Monday, Tuesday, Wednesday, Thursday. Now the financials are getting hit, and they're getting hit hard. There's no question about that, right? But this is one of the first things that I think it's a little bit of a warning shot. This is a marketplace that just started to sell off. The financials, that is, just started to sell off. It was up 9% on Monday on a year-to-date basis. Well, now it's only up about 2%. So it's had some sell-side activity, but it's really hard to call like, oh, we've hit a bottom. The other thing that really is bothersome, so that's the first aspect, is in the financials. I just thought that was interesting because we were selectively selling off, and we were just selling off in big tech stocks, and everybody's like, people just, like a moth to the flame, oh, look at NVIDIA has been selling off, and like, oh no, oh, Meta, which didn't have like, one down day for like 15, 20 days in a row, all of a sudden hasn't had one up day. Okay, well, the day is young and maybe it still happens. Anyway, the point that I'm trying to make is people were so myopic. Oh, let's look at the financials over here. Look around. Look around, because what I see is, again, what I term kind of selective selling. If you look at the again, home builders, the home builders getting decimated out there, no question about it. Then bring up XLY. XLY, it's been getting decimated. By the way, XLY, okay, for those of you that don't know, this is consumer discretionary, but XLY is really like Amazon and Tesla. Okay, so it's been getting hammered pretty hard. It's down about 7% on a year-to-date basis. XLI, it's the industrials. The industrials, maybe a little bit of a bounce today. Okay, here's where things get a little bit more complicated. You start looking at XLU. This is the utility sector. Utility sector on a year-to-date basis. Okay, actually up 1.4%. SMH, well, you would expect the semis to actually do fine. Here's where we start getting really contentious. Healthcare right now is actually up almost 9% on a year-to-date basis. Okay, and I say it's contentious because ultimately, when you see big sell-offs, okay, you rarely see sectors that are going to perform. I mean, yes, sectors will perform better than others, but sectors that are actually rallying, because we're still seeing rotations. If you look at the XLP, okay, again, this is what? Consumer staples. And I just want to clarify for everybody, it's consumer staples, and consumer staples, it's up like 6%. Consumer seems fine out there, right? This is materials, and materials still up like 6%. XRT, now this is the XRT, which is, a retail ETF. This one's getting beaten up to the tune of 10%. XLK, which is technology, right? Okay, then you come into the regional banks. The regional banks are down by about 3%. The point being, there's still selective sell-side activity. Okay, there's still selective sell-side activity, and as I said, that does not make me feel warm and fuzzy. With selective sell-side activity, I then deviate and cruise right over to correlation, because the correlation, we hit for a brief period of time on Thursday, we hit higher degrees of correlation. And I keep kind of pounding the table on this one, because what we just have not seen for a considerable period of time is, like, you want to see a wild and woolly kind of sell-off in the marketplace, right? So, you had a day where the S&Ps were down 120. You want to see every single stock in the S&P 100 or the S&P 500 just kind of puking their proverbial guts out. And we simply just haven't seen it. We had, again, on Thursday, we saw a short period of time where the markets had higher degrees of correlation. Okay, and again, Thursday doesn't look like much of a trading session in here, but it was. Okay, and again, we hit higher degrees of correlation. By the way, these days are just huge ranges, just absolutely huge. Doesn't do it justice, but they're absolutely huge, right? Huge trading sessions, but the correlation is clearly not there. And without correlation, it's almost impossible to have capitulation. So we're seeing, and again, the selective, sell side activity. Okay, goes right hand in hand with correlation, goes right hand in hand with talking about the financials. It's all kind of one and the same, right? Okay. You want to see when this marketplace gets hit, everything's got to get tagged. Or in my opinion, we're just not home yet. And home being like, you're not finding a bottom. Okay, you're not finding a bottom from where I sit until you see higher degrees of correlation. You're not finding a bottom when you have a sector, okay, like the financials, that literally hit its all-time high on Monday. Well, holy crap, it's Friday and it's down, but it's down. This thing just it's like scraping the surface, like, ooh, hit me, okay? It's kind of a nothing move at this point in the financials. So has damage been inflicted? I mean, come on, people. Financials are not even back to where they were in the beginning of the year. right? You look back to like, the time of the election, this thing's got to be at 46. That still leaves, okay, considerable. Like downside, we're not even back to where we were in early November. And it's so difficult, okay, for me to tell people like, hey, look, like if this sell-off really gets going over here, you very well could be facing a little bit more of the abyss. Okay. What do I mean by that? Oh, I mean, look, you want specific levels to it. Like, why not go to, 5,200? There you go. And 5,200, you're just back to where you were in August. That's like not that much damage inflicted. And that is something you need to keep in mind. When you start looking at a chart, the other thing you want to do, especially in the midst of volatility, stop at this crap in 9 months. Okay. At minimum, start opening up to like 3 years. Wake yourself up. Okay. All of a sudden you look and go like, oh yeah, that thing could easily get to 500. That's the spiders. The spiders could easily get to 500. Okay. That's another 700 points, Don, in the SPX. It is. Okay. But in a larger sense, why not? You realize getting back down to 500, I mean, come on, that's just, erasing some of the gains from last year, but not even all the gains. Because even last year, I mean, that thing started in what, 470 and change. The last time that we had a decent, bearish marketplace obviously was 22. And all that we did in 2022, and I'm actually kind of highlighting it in here, all we did basically in 2022 is give back the prior year gains. Okay, that's it. It wasn't even that bad. So if you gave back like, the prior year gains, where would you be? Oh, ruh-roh. Okay, probably somewhere, let's call it like 450. Okay, 450 in there. I'm not saying we're going down that far. All I'm saying is open your chart up more than 9 months. Okay, why? Because somewhere in this chart, you need to see some semblance of reality. And I don't think that people live there right now. All right, this is why I was going a little nuts on the Wednesday night video, and I'm going to do it again. And that is, on the Wednesday night video, I was talking about the simple moving average. And the simple moving average, I was listening to some talking heads out there, and they were talking about, well, we touched the 200-day moving average. Okay, by the way, this was also in all kinds of newsletters and so forth. We touched the 200-day moving average, and that means we're going to bounce. Okay, like really. And again, I want to reiterate this. It's a moving average. Okay, which means you're going to have some price action up here and you're going to have some price action down here. You want to know why they call it an average? Because it's dead in the center. Like, think about that for a second. It absolutely blows my mind that people are like, well, we touched the 200-day moving average, and if we touched it, that's enough to bounce back up. It pretty much defeats the purpose of using a 200-day moving average, because you're going to ebb and you're going to flow on both sides of it. And if actually you look at this for a longer period of time, as I said, you got to wake up. Right? You start looking at it for a longer period of time, you're like, holy crap, he makes a pretty good point. This marketplace should spend, time above it, but this marketplace also should spend considerable time below it. That's the 200-day moving average. Now, again, that's for what? The last 3 years. Okay, let's get crazy. Open up a bigger time frame over here. This is a 5-year daily. Just really showing you, okay, look, the market's allowed to be below the 200-day moving average, and it is there for considerable periods of time. And I'll snap this even to a 5-year weekly, okay? And on a 5-year weekly, now this is a little different because it's a weekly, but it's a 200-day moving average. That's absolutely wild. By the way, it obviously changes the calculation considerably when you bring up a weekly, because then it's basically instead of a 200-day moving average, it's 200-week moving average. Look how far departed we really are. All right. All right. And it gets even worse, by the way, when you start pulling up things like monthlies. And that's usually when panic kicks in. Great. I wanted to get that in there. Okay. So correlation's still not there. Obviously, the financials just hit an all-time high. It's weird to say that. They hit an all-time high. That happened this week. Can't make that crap up. Now, let's get into areas of volatility. A few things in terms of volatility. One of the first things is, we talk a lot about what's termed contango and backwardation, and we're still in the throes, and I'm going to freeze the screen for a minute. We're still in the throes of what I term kind of a big boy backwardation, and that basically means the March volatility, is above the April volatility, but the April volatility is still above May. This March is getting very short on time. I'm almost going to extract that. We're still in like a 30 cents inversion in here. So volatility is still absolutely inverted, or maybe a little less than it was earlier today. Moreover, if you kind of follow me to the bottom of the screen, you're going to look at products like, VVIX. This is the volatility of the VIX. That's still up above 110. That's what we call kind of the VAMA zone. That's usually when you're like under your desk, kind of rocking back and forth. Look, you may see volatility down a little bit today. That's because we just got through a big enchilada. There was a jobs report. Woo! Okay, got through the jobs report, got through a Jerome Powell speech. Okay, got through a couple of Trump administration tweets over here. So yeah, volatility got crushed down. But when it comes to volatility, I say big boy, okay, backwardation. When it comes to volatility overall, let's do it. Let's bring up the VIX. Okay, one thing I've also talked about incessantly is hitting the 27 level on VIX. Okay, and ironically, we got within, hop, skip, and a jump of the 27 level on the VIX. But the point being, okay, with VIX, why the 27 level? Like, what's so interesting about 27? 27 is basically a historical standard deviation, okay, for VIX. What that basically means, right, is that the VIX on a one standard deviation move, okay, moves to like 27. So if I give it to you another way, okay, what I'm saying about VIX, historically speaking, the VIX, let's say, has an average of 20. That's pretty much the whole history of VIX. To the upside, to the downside, right, 13, okay, and basically 27. Those are roughly, okay, it's standard deviation. So the VIX actually getting to about 27, you'll see it actually crack into 27, and often the market can actually bounce to a degree from there. What I do not like, and again, I like to point out things that look a little bit ominous, if you will. Okay, am I a bear? I already said I was a bear. I'm a bear though because they're selective selling. But I'll further my bearish tilt a little bit here. And the reason I'm going to further my bearish tilt, I don't like what volatility is doing right now. There's no fear. There's no loathing. Like nobody's panicking in here. That VIX, okay, is methodical. Now, again, I'm not a big proponent of VIX, but all the volatility indicators are too methodical. Okay, what do I mean by that? It means the sell side activity hasn't driven anybody to the edge. The sell side activity hasn't driven anybody to true fear and loathing of the marketplace. Okay. I hope that really resonates with you. If there's one thing I want to resonate with you on this weekend update, it's just that. I mean, again, I can point out a lot of things, but the more I think about it, the more I look at it, I actually sit back from the screen and like, holy crap. Like, look how well we've actually taken the sell side activity, right? Again, it's very methodical. You don't want to see methodical when it comes to volatility. You want to see volatility freak out. You want to see volatility actually crack, not above 27. I mean, hell, let's get to 35. Let's get to 40. You got to have a freak out. Why? Because if you don't freak out in volatility, how do you bottom? So when I say volatility is raging, the irony is volatility really isn't raging. Volatility is actually what? It's pretty methodical. Where volatility is raging is in the short duration. Short duration options are actually showing that volatility is quite high. I mean, even into like Monday and Tuesday and Wednesday of next week, crap load of volatility, like no question about it. But the bottom line is, okay, 30 days out, which is VIX. VIX is volatility 30 days out, far too methodical. Let's have a freak out session. Let's get it done. All right. Now, you're going to have some rallies in the coming days. No question about it. Again, that's the hallmark, if you will, of sell side activity of some of the rallies. In the rallies, okay, bottom line, be careful. Use spreads. Okay, be careful and use spreads if you think a rally is coming. Actually, I have one on. It's not going to make money today, but I actually have a spread on, and I have a spread that expires today. Why do I have a spread on for an intraday trade? You got to protect yourself from the volatility crushes. Because the moment that you even smell the marketplace starting to rally, okay, they're going to vol crush you. And the only way to really protect yourself from a volatility crush is to isolate and insulate yourself from volatility. What you basically do is you buy one option, sell another option. Why? Because you want to negate your volatility exposure. You need to use spreads, people. It sounds so crazy. Like if you want to just trade a futures contract, sure, go for it. But a futures contract, if you're wrong, holy crap, you get your head taken off out there if you're wrong in the futures market, right? So when you're looking at this, okay, maybe use spreads, even on an intraday basis, because as I said, you're isolated, insulated, if you will. Like if I wanted to get bullish just for Monday, like you just think that the futures are going to open and they're going to rip on Monday, okay? Just do a spread. Like literally, like do a spread like this. And you know what? There's nothing wrong with that. This is like a $6 wide spread for like, $2 and change or whatever. But if we do rip higher, okay, you just leave the trade on to right before expiration, or even if both strikes are in the money, you can leave it on through expiration. Can't stress that enough, okay? Can't stress that enough. By the way, it's been a great trading week. It's been a phenomenal trading week. In-out spreads, okay, took profitability in XLU, that's the utilities, okay? So in the utility sector, took that trade off and made over 59% in that one. That's actually an in-out spread. So killing it in in-out spreads. This is an in-out spread here. This is an in-out spread in XLV, okay? We took a trade off. You'll appreciate this. We even took a trade off in VIX, okay, this week. In terms of VIX, we killed it, bought that one for 340, sold it for 575, okay, and it goes on and on. Like this week, it's a really, really strong week for trading. I mean, the number of trades I actually ripped off this week, okay, it's phenomenal. Again, a lot of good trades throughout the course of this week, and I'm going to tell you right now, there's a lot more coming. Why? Okay, wait till you see the volatility for next week. So, okay, place that I always like to kind of leave you here on these weekend updates. Obviously, on this weekend update, what am I leaving you with? Look, expect rip your face off rallies. This is volatility, people. It's volatility 101. Expect rip your face off rallies. If you are going to go after a rally, okay, define that risk, use a spread. Don't just go out and buy a call. Don't do something like buying a call because you're going to buy a call and they're going to vol crush the living crap out of you. All right. So use some spreads, okay, in a VIX that's this high. You got to protect yourself because when they do crush that vol, it's going to be big. The next thing, okay, you're coming out of a week that we just had a $122 move. Okay, so expected move, I should say. So here we have an expected move of plus or minus $122. Okay, now the downside of this expected move, okay, was right in the neighborhood of 58, basically 30. Where are we actually closing? Okay, somewhere in the neighborhood of 57, we'll call it 50. So we are most definitively outside the edge of the expected move. Things, like last week, we rallied back into it. The week before that, we were outside. This week, we're going to close definitively outside the expected move. When you start closing outside the expected move, it basically means markets are getting crazy. Markets are ripping themselves apart. But more importantly, okay, don't take my word for it. Take a look at what the expected move is next week. So we had a jobs, number this week, and there's more data coming next week. But next week, people, you're going to face $150, okay, expected move. Now, we're not done yet. There's still 15 minutes left in the trading session here, but you're looking at right around plus or minus $150 expected move. So as I said to you, okay, even though I would anticipate some rip your face off rallies, okay, there's no question in my mind here. We're not done yet. Does it mean we're headed into the abyss? Not necessarily, okay? But I do not think that we've actually found a bottom yet in this marketplace. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.